There's no obvious catalyst in the next, through the end of the year, outside of the macro environment. I do expect that there will still be kind of a bull market. I do issue a word of caution, though, that people who are expecting the bull market to be hundreds of percent from here, I think could be quite disappointed. My guess is that we should expect the volatility in each cycle to go down over time. There is one thing that every politician in America agrees on. They're going to devalue the dollar. That one data point is the single intelligence test for investors over the next 10 years. If you realize they're going to devalue the currency, you should get long financial assets.
Pompliano begins by addressing the current market conditions, noting the absence of a clear catalyst through the end of the year, apart from macroeconomic shifts. While possibilities like interest rate cuts or unforeseen geopolitical events could serve as potential drivers, he emphasizes that the market lacks a definitive trigger, akin to last year's ETF approval rumors. Interestingly, Bitcoin has maintained a 50% gain from its pre-ETF levels, even though prices have stabilized during the summer. Investors are still in a generally bullish environment, but Pompliano advises caution. Those anticipating explosive gains in the hundreds of percentage points could be disappointed. He predicts a gradual decline in volatility over time, aligning with broader market patterns. As Bitcoin matures, the wild price swings of previous cycles are likely to reduce, making it still attractive compared to traditional assets like the S&P 500, but less explosive than in the past. This maturing market, combined with the overall macro environment, sets a more realistic tone for the future, one that rewards patience and strategic asset allocation. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
There's no obvious catalyst in the next, through the end of the year, outside of the macro environment. So the macro environment, if they cut interest rates, there's, things around the election there that could potentially happen. Maybe a potential catalyst, although it isn't guaranteed to happen before the end of the year, as the sovereign wealth fund comes out and says they bought Bitcoin or something. But there's not a very clear, hey, this is going to happen. If you go back to this time last year, when the ETF was being rumored to be approved, it was very clear. If this gets approved, this is going to be a catalyst in price. It is worth noting that we are still up about 50% from before the ETF got approved. So we kind of got this repricing. We've gone sideways for the summer. I do expect that there will still be kind of a bull market. I do issue a word of caution, though, that people who are expecting the bull market to be hundreds of percent from here, I think could be quite disappointed. My guess is that we should expect the volatility in each cycle to go down over time. And so it'll still be attractive compared to the S&P, but it shouldn't be, hey, we're gonna go from 50,000 to 500,000 or something like that in the bull market. There is one thing that every politician in America agrees on. They're gonna devalue the dollar. That one data point is the single intelligence test for investors over the next 10 years. If you realize they're gonna devalue the currency, you should get long financial assets, because all of the financial assets are denominated in dollars. So why do real estate investors always make money? If I buy a piece of real estate and I hold it for some period, especially long-term period, somebody is going to have to show up with more dollars in the future to buy that same piece of property. In a lot of cases, it's not like the land got more valuable or the house, all of a sudden a bunch of things got built around it, etc. It's that the dollar, the thing it's denominated in, is worth less. And so if you look at home prices in America and their average appreciation over the last couple of decades, it mimics about the loss of purchasing power in the dollar. It's kind of a 45-degree angle up and to the right. If you look at the stock market, very similarly, it's a 45-degree angle up and to the right at about 8% a year. And so that is the dollar losing purchasing power, which means somebody in the future will buy that same asset from you, just need more dollars because they're cheaper in terms of value. And so that is the argument as to, rather than trying to time markets and do all this stuff, the US stock market is a millionaire minting machine. if you simply keep allocating. If I remember the stats correctly, new all-time high at Fidelity for the 401k accounts. There's 497,000 of them now. On top of that, 42% of financial asset allocation is going to stocks, which is also a new all-time high. There are two things that I think you can take away from this. The bull case for this is, well, people have been invested in the market. The market's gone up a lot. It's minted a bunch of millionaires. The US stock market is the single greatest millionaire minting machine ever created. It mints millionaires. If you allocate to it, you keep investing in it, you think long-term, and you do it for decades, right? So kind of the timeless investing principles end up actually working over a very long time period if you can ignore the short-term volatility. The second thing is not only for kind of minting a millionaire, but if you've been invested, stocks go up, you keep putting more money in, right? You keep buying. And so there is a lot of data that suggests that buying all-time highs leads to more all-time highs. I think this year alone, there has been almost 35 all-time highs in the US stock market. So obviously it keeps going up. The bear case is what you're talking about, which is, oh my God, everyone's overexposed to equities. There's the big crash that's coming next. I actually think this is the wrong framing of like, is this good? Is this bad? Instead, what gets lost in that analysis is what is the time frame in which you're looking? I have no clue and wouldn't try to predict what's going to happen through the end of the year or what's going to happen in the next 12 months, right? I think that's a fool's game. There are some people like a Renaissance. We're very good at figuring out what's the price of, a certain stock going to be at the end of today. That's not my game. Instead, I think the average American is much better off saying to themselves, what is the timeline on which I am investing? Can I invest for 5 years, 10 years, 15, 20 years? If that's the case, the price tomorrow does not matter. And so instead, what they need to focus on is how do I continue to dollar cost average into a great asset that I can hold for 5, 10, 15, 20 years? In that case, now what you're really talking about is you actually may want prices to go down. Because if you're going to keep allocating and dollar cost averaging, you're buying up the asset as it is cheaper. And so let's say that you're going to buy an asset and hold it for 20 years. Actually, you want the asset to go down for 19 and a half years. And then right before you're going to sell, you want it to explode upwards, right, in more value. That's not how it works. The stock market's going to continue to go up. And so I do think that kind of that long-term thinking, the beauty is that you can have that viewpoint because the US dollar is going to be devalued because they've got to be able to monetize the debt. And so as long as that dollar gets devalued, stocks will go up over the long run. You just have to have the stomach to be able to withstand the volatility in the short term and keep that long-term perspective. If you do that, you'll be fine. If you understand Bitcoin, you get excited when the price goes down because you can accumulate more at a lower price. The other thing is that people who hold Bitcoin are active users of Bitcoin. It just doesn't show up in the data. Part of Bitcoin's story is that it's a store of value. So if you're storing your value, you're using the product. You're an active user. You're a daily active user. And so, yes, people do look at things like transaction volumes and activity as a sign. And then when price goes up, of course, people are trading, they're transacting, they're moving stuff around. So you would expect price goes up, transaction volume goes up, price goes down, transaction volume goes down. But the unique thing is for a store of value, a holder is an active user. And so there are hundreds of millions of active users around the world. We just don't think of it that way because it doesn't show up in the data in a way that if you're looking at a mobile app or something like that.
Pompliano shifts to discussing Bitcoin, emphasizing that those who hold Bitcoin and use it as a store of value are active users, even if they aren't transacting on the network frequently. While transaction volumes often correlate with price movements, this doesn't account for Bitcoin's broader use case as a store of value. In this context, the mere act of holding Bitcoin qualifies as participation in the network, meaning there are far more active users than transaction data might suggest. This distinction between transactional and store of value usage underscores Bitcoin's role in the financial ecosystem. As a decentralized, digital form of money, it provides a hedge against the dollar's inevitable devaluation, making it a crucial asset for long-term wealth preservation.
Understanding why capital gains tax, especially long-term capital gains tax, exists is really important. So the idea is we have ordinary income tax, and then we have long-term capital gains tax. The reason why it is long-term capital gains is it's trying to incentivize you to make investment, to be long-term thinking. And so they say, if you make investment in our long-term thinking, if you're investing in America, we will give you a lower tax rate in order to incentivize that, right? Taxes are an incentive system. And so if you go and you look at that, people will always yell and scream and say, oh, wealthy people disproportionately benefit from long-term capital gains. It's only 20% compared to whatever the ordinary income tax level is. The part that is left out of that analysis is it is usually the wealthy people who are making the long-term investments. So it is available to any American. It's just that one group has the capital to do it, the other group doesn't. And so it's not about the tax thing being somehow skewed in one favor or the other. It's that one group of people has capital and they understand the incentive and they're leveraging the incentive. But anyone, any American who buys an asset, holds it for over a year, they get long-term capital gains tax. So it's not really skewing anything. It's all about kind of education and then action. Now, when we look at that 20% level, that is a number that they came up with where they're trying to kind of do a high wire act. They want, on one hand, to incentivize long-term investment in America. On the other hand, they need tax revenue, right? They need the tax receipts. And so in order to do that, they picked 20% as the number. Now that number has actually fluctuated quite a bit. We have seen a number of different things. If you go and you just Google history of capital gains tax in America and read the Wikipedia page, you'll be blown away by how much it has changed and changed in our relative lifetime. In the last 50, 60, 70 years, we have seen a ton of change there. We've seen change in the percentage, but we've also seen things change. Like right now it's set at 1 year. So if you hold the asset for 12 months in 1 day, then you get long-term capital gains. There have been proposals and also plans in the past where maybe they have a one rate for if you hold 1 year, another rate if you hold 3 years, another rate if you hold 5 years, etc. And so they play with the timeline and the percentage. It becomes pretty interesting, but it's more complex. Now, if we go back to Harris's plan specifically, 20% is where we're kind of sitting at today. Biden came out at 39.6%, and people had an absolute field day in terms of their backlash around doing this. How can you go from 20 to 40? You're basically doubling it. You're going to disincentivize investment in America. I would push back on that and say, I don't actually know if you would disincentivize investment because people aren't just going to go move and sit in cash, right? So they're still going to invest. What you're probably doing is you're deterring future investment. You're deterring kind of net new dollars on top of what people are already doing. So if you want to increase the amount of investment, you would actually have to drop the rate, not just keep it similar, right? So staying at 20%, you should expect to keep getting the amount of investment that you're getting, keep that rate just extrapolated out. If you were to drop from 20 to 15, a lot more people probably would go invest because like, oh, the rate's dropping, the incentive is higher, therefore capital changes kind of the allocation strategy. Now, at 20%, we're never going to go to 40. 39.6%, that's insane. No way you're ever going to get that passed. What Harris did is she basically has said, well, wait a second, everyone's anchored on this 39.6%. I've been backing a lot of the same Biden economic policies. They expect me to come in at 39%. If I come in at 28%, I'm actually in a weird way moving more to the center, even though she's increasing the rate by 40%. There's a 40% increase she's proposing in the capital gains tax rate. Now, Harris and Trump both are populist candidates. They're going after the working class. And so it's really easy to say, oh, but we're only going to do it for people who got over $1 million. Immediately, a huge portion of the population says, well, I don't got $1 million. Like, I don't care what you do to those people. Take all their money. And so by approaching it from this populist perspective, what you end up doing is the most important vote in this election for both Trump and Harris is unaffected by this policy. And so she kind of doesn't care if she pisses off a bunch of rich people.
Pompliano also touches on the importance of understanding long-term capital gains tax. Designed to incentivize long-term investment, this tax structure rewards investors who hold assets for more than a year with lower tax rates. While some critics argue that the wealthy disproportionately benefit from this system, Pompliano counters that anyone can take advantage of it. The real difference lies in education and the availability of capital, not in the tax system itself. He explains that the government has carefully balanced the tax rate to encourage long-term investment while also generating necessary tax revenue. Although there have been proposals to increase capital gains taxes significantly, Pompliano believes that such moves would ultimately discourage future investment, harming the broader economy. Please like and subscribe my channel.